Everyone is wrong about starting investing in 2026. Simple strategies build wealth even during crashes and market chaos. Welcome to Money Clarity Hub. 2026 may feel like the worst possible time to start investing. Markets are unstable, headlines are scary, and beginners feel like they're already too late. But that is exactly why this matters now. Because the biggest mistake is not starting in a bad year, it is waiting forever for a perfect one. In the next few minutes, I'll show you exactly how to start investing as a beginner, what to avoid, and how to keep it simple from day one. If you resolve to start investing in 2026, this is a fantastic decision. I know the world of stocks and bonds can feel like a maze designed to confuse beginners, but let us strip away the noise. Investing is simply making your money work for you so you do not have to work for money forever. You are buying small pieces of amazing companies or assets that grow over time. Forget the flashy day trading nonsense you see on social media. Real wealth is built with patience, consistency, and a solid plan. Take a deep breath because we are walking through this together, step by simple step. Before you buy a single stock, you need to lay your foundation, and that starts with emergency savings. This is your financial safety net, so you never have to sell investments in a panic when life throws a curveball. Aim to set aside 3 to 6 months of essential living expenses in a high-yield savings account separate from your investing cash. This is not the exciting part, but it is non-negotiable and separates successful investors from stressed ones. Once that safety net is secure, you can invest with confidence, knowing you are playing the long game with money you will not need tomorrow. Now, let us talk about the mechanics of getting started, beginning with choosing a brokerage account. Think of a brokerage as the doorway to the stock market, a company that lets you buy and sell investments. In 2026, you have fantastic options like Vanguard, Fidelity, Charles Schwab, Revolut, or user-friendly apps perfect for beginners. Look for zero account minimums, low fees, and an intuitive platform. You will likely choose between a taxable brokerage account or a retirement account like a Roth IRA, which offers amazing tax advantages for long-term growth. Take your time, pick what fits your goals, and do not be intimidated. You have your brokerage account, so what do you actually buy? This is where beginners overcomplicate things by trying to pick individual stocks. Instead, meet your new best friend, the low-cost index fund or ETF. These are baskets holding hundreds or thousands of different stocks in a single purchase. By buying one, you instantly own a tiny slice of the entire market, giving you massive diversification. Diversification is simply not putting all your eggs in one basket, which dramatically lowers your risk. This is the smartest, simplest move you can make as a beginner, and it sets you up for long-term success. For your core portfolio, you really only need two main ingredients to keep things simple. The first is a total US stock market index fund covering large companies like Microsoft and smaller ones you have never heard of. The second is a total international stock market index fund because big opportunities exist outside the United States. A classic approach is to choose a ratio matching your risk comfort, like 70% US and 30% international. There is even a target date fund that automatically handles this mix for you, adjusting to become safer as you near retirement. That is investing on autopilot. Let us destroy the biggest myth that keeps people on the sidelines, the idea that you need a ton of money to start. In 2026, fractional shares have changed the game completely. They allow you to buy a piece of a stock or fund based on a dollar amount, not a full share price. If an ETF share costs $300 but you only have $50 to invest, you can still buy $50 worth. You can start with $5 or whatever you can comfortably afford. Consistency matters far more than the initial amount. Set up a small, recurring automatic transfer each month. You are building the habit, and that habit builds wealth. Let us talk about the emotional side of investing, because your behavior determines success more than your stock picks. The market will go up, and yes, it will go down, sometimes dramatically. When the market drops, it will feel scary, and the news will scream disaster. But here is the truth. Downturns are not losses unless you sell. They are simply the price of admission for long-term growth and are actually the best time to buy more shares at a discount. Your job is to ignore the noise, stick to your automatic investing plan, and remember you are a long-term owner. Zoom out on any market chart, and you will see the history trends upward. A huge piece often overlooked is taking advantage of accounts with tax benefits, especially if you have a job. If your employer offers a 401k with a company match, that should be your very first stop. A company match is free money. You contribute a percentage of your salary, and your employer matches it up to a certain limit. That is an instant 100% return on your investment, unmatched anywhere else. Even if you can only contribute a small amount to get the full match, make it a priority. After that, look at a Roth IRA where your money grows tax-free forever. This is a powerful combination for building serious wealth. As you start investing, you will hear about complex things like options trading, crypto, or leveraged ETFs that promise huge returns. My advice to you as a beginner is to smile, nod, and politely walk the other way, at least for now. These are sophisticated, high-risk tools that even professionals use incorrectly and are not part of a simple, foundational strategy. Your goal in year one is not to get rich overnight, but to build rock-solid investing habits you can maintain for decades. It is far better to make steady, boring progress than to take a risky gamble that could wipe out your starting capital. Finally, let us wrap up with the most important concept: time in the market beats timing the market. No one can consistently predict whether the market will go up or down next week or next month. No one can predict the dramatic events that are bound to happen in the world. Trying to wait for the perfect moment to jump in usually results in missing the best periods of growth. Your superpower as a beginner is that you have time, allowing compounding to work for you. Compounding is when your investment earnings generate their own earnings, creating a snowball effect that grows your wealth exponentially over years. So start today, start small, stay consistent, and enjoy the process. Good luck. Thanks for watching Money Clarity Hub. Subscribe for more weekly insights and explore the video playlists.